Describe, especially for younger people, the Freedom Fund.
Well, the Freedom Fund is this idea nobody wants to save, right? And millennials right now are doing the worst job of it in a long time. And it's not because they don't care or they're irresponsible. It's frankly, they don't trust the market. You know, they saw what happened in 2008. They don't know where to really go. And so they're being stimulated like crazy and they're spending like crazy. But if you really want to have freedom, then what you have to do is you've got to take that percentage aside like Theodore Johnson did. And you got to just say, this is for me. This is my freedom. There's a part of what I earn, as basic as it is, we all know this from investing, there's a part of what I earn that is mine and my family's to keep and no one's going to touch it and I'm going to grow it. But I also believe that where you put that really matters. And so indexing is the most basic way to do it for sure. But what all these investors showed me is asset allocation is where the difference is in business, right, in life. If you look at it, the fourth key we talk about in the 4 steps is you got to really understand asset allocation. Because when I was with David Swenson, Dave said, Tony, I said, what are the dials you can move? I mean, there's a limited number of dials you can move to increase your returns, to get to your financial freedom faster. He said, Tony, there's really only 3. He said, you can make a better choice selection of the actual investments or the securities. You can have better timing or you can have better asset allocation. He said, let me give you a clue. The first 2 will never happen. He said, because they cost money if you get them from somebody else and everybody's wrong on timing, everybody's wrong on the stocks. This is where all your money is made as asset allocation.
This leads to what sounds, goes against all the conventional wisdom, what you call all-weather allocation.
Yeah, well, let's talk about that. That's
which stocks only 30%.
Yes.
Explain.
Yes. Well, I sat down with the famous Ray Dalio, right?
Right.
And I prepared for 18 hours for that interview because he's a genius and there's not that much on him and I wanted to absorb it all. So I got every little bit of it, sat down with him, and it turned out Ray was a fan of my work, which I was touched by 20 years ago. I guess he listened to my program, so he was very generous with his time. And we spent these 3 hours, and in the 3 hours, when I got to the end, I said to Ray, I said, listen, I really want to help the average person, so I got a question for you. I did this with everyone. I said, if you couldn't give your money to your children, any of it, and all you could do would be give them a portfolio or a set of investment strategies or instructions, and they were going to start over and build it, what would it be? And he said, Tony, I spent a decade figuring that out. All my money's already there. My kids' money is there. My money from philanthropy when I'm gone is there because I'm not going to be here, and I want something that'll do well in the future, and I don't know what the future is going to be. Markets are going to always change. I need something that could work in any market. I call it my all-weather fund. Most of us in the business are familiar with it a little bit. And so he explained it to me, and I have a good understanding. And I said, I get it. So what you're saying is the reason why, this was obsessed him. Why is it if I have a balanced portfolio in 2008, I got nailed on both sides?
Exactly.
You know, why did that happen in 2000? Everybody says portfolio theory, this is supposed to protect me, and it didn't work. But he said, as soon as things get better, no one talks about it, we just forget about it. It happens again. Happened in 2000, happened in 2008. He said, I figured it out. When you have a 50-50 portfolio,
right,
that's 50-50 of where you put your money in assets. 60-40, 50-50, however you look at balanced portfolio, right? But he said, the problem is that's not balanced risk. And this is where people are crazy. I've seen people write things up. They see this in the book and say, Tony Robbins is promoting. First of all, I'm not promoting anything. Every word in this book is from the best investors on earth. Anything that's from me is about the emotions. That I know for 36 years. That's been my expertise. These are their views. But I'll tell you what's amazing. He said, Tony, when you have stocks and bonds half and half, you're not equal because equities are 3 times more volatile. So your risk is 95.5. And he said, so that's why people get killed in 2008. And he said, I try to get this through to people. He said, but all of our people handle it. You know, you manage money for countries, the largest, pension funds on earth. He said, but people don't listen. They look at it and go, oh, this is bond heavy. The bond days are over because inflation's going forward. He said, it's not true, Tony. This fund in the 1970s, it was the worst time for bonds and it was an extraordinary time for all weather because it isn't. It looks overbalanced because in order to get the same level of risk, you have to go for more long-term bonds or you have to use more leverage on the bond side. And so when he was all done, it was, for the average person complex, I'm seeing financial people look at this and write things up that are just silly, saying, this is never going to work because we're in the, interest rates are the only place to go. If interest rates go up, it's a balanced fund. The other areas kick in. But here's what's interesting. After he told the whole thing to me, I said to him, look, this is wonderful. You've given me something that very few people understand on the planet. I think I really got it. And I played it back to him. He said, you got it. I said, but here's the problem. The average person is never going to know what to do with this. And I said, I'm trying to help somebody that needs to know what to do. I said, you're telling me to make this beautiful chocolate cake, and you're saying, Tony, here's how to do it. Use some sugar, right? Use some chocolate, use some dairy products. I need to know the amounts, give me the amounts. He goes, Tony, that's my secret sauce. And that's when he told me, he said, look, 10 years ago, for you to even get in to talk to me, it was $5 billion net worth, $100 million to get in. And he said, and now for 10 years, I haven't taken anybody's money. And so you answered your own question. I said, you're not taking money anyway. It's not going to compete with you. The average guy, he says, never going to make it talking to a wealth manager. Tell me what to do. And he's so generous. You know, he's giving up half his net worth like many other people. And in the end, he said, okay. He said, but it'll be complex. I said, I can make it simple. He said, well, I don't want leverage in it. I said, design one without leverage. He goes, it won't be perfect. I said, I don't care if it's not perfect. Your idea of unperfect will be somebody else's idea is the best thing they could do. And they laid out the numbers. We ran the numbers and used the same back testing. So you saw year by year how it really did over the last 75 years of modern investing. And here's what's amazing. Like all weather, similar. In 75 years, it's been right 85% of the time. What's even more extraordinary is the 15% when it wasn't doing well, when it didn't do well, its average loss was 1.6%, not 50, 40, 30, 20. Think of the last 10 years, the 250% hits. His biggest loss in 75 years was less than 4%, minus 3.95. And that was 2008 when the market exploded, down to 51% from peak to trough.
Here are the allocations
Yes.
in the book, which would make a normal person gag, at least initially.
That's
Stocks only 30%.
That's right.
Even though the stocks on average are supposed to gain, 9% a year?
Yes, 9.2.
Long-term treasuries, 40%.
Yeah.
Intermediates, 15.
I know.
Gold, 7.5. Commodities, 7.5.
Yeah.
Absolutely counter wisdom.
I know, and it's amazing. When I interviewed David Swenson, he said he wrote a book, and when he said the whole secret to success is to be contrary to what else believes, but the math on this is what works. Here's what's interesting. That looks like your heavy bonds, 40 and 15, 55% bonds, and it looks that way visually in terms of volume you are, but in terms of risk you're not. You're making it so you're equally weighted. Think of it this way. What triggers things to grow is inflation or deflation in terms of price. Certain things do really well in inflation, certain do in deflation. Growing economy, shrinking economy. And he's figured out which quadrant you need to put each to actually have equal risk. And that's why it's done well. This year, this formula is done, it's 1% better than the market. It's in 13 in the third right now. But more importantly, 3 weeks ago when the market dropped and gave up all of its entire benefits for the entire year and everybody's guts were checking, there was no gut check because it went up 1/4 point. So the beauty of this is, I'm sure you know, there was a study done the last 20 years, and the studies from 1993 to 2013, and it's by Dalbar, and they found that the market, S&P 500, during that time did 9.2% on average, just as you said. But do you know what the average mutual fund investor? 2.5%. That's before tax. Why? Because we as investors always do the wrong thing.
Emotions.
That's right. We sell when we should hang on. We buy when we shouldn't. So the greatest thing that I think that Ray offers somebody the opportunity to do is actually stay in the market. Because if you got 1.6% as your big hit, if 4% was the biggest hit you've ever seen in 75 years, I think you could stay in and you can do what Jack talks about, which is stay in that market through time.
Of course, this means resetting each year.
It's a reset once a year. That's the one, recalibration. So 15 minutes a year and you're in the game.